If you've watched the equity markets over the past few sessions and particularly today, then, well, it wouldn't have made you very happy. But it turns out that these losses, when you zoom out, will seem like very minor blips. And if you think about it, over the long term, if you stay invested in equity, is always considered to be a good idea. But having said that, there are a few things that are done by investors that lose them more money than is lost in the equity markets. Join me to talk about those mistakes and how to mitigate them and avoid them is Mrin Agarwal, the founder director of FinSafe. Thank you so much, Mrin, for taking the time, and pleasure speaking with you. You know, I asked you in advance what these major mistakes are, and the first one that you listed is an interesting one: not taking enough risk. Uh, on a day like today, when the equity markets have declined so substantially, some people might be thanking their stars, Mrin, for not having taken that risk. But is that a bad thing?
So, good evening, Alex, and nice to be on your show. Yes, I think in the long term, as you said, these ups and downs are going to keep happening. Of course, some days you have larger ups and larger downs. But I think when you look at it more from a longer term basis, you really need to see how is your portfolio doing overall. So, for example, let us say that you have only 5% equity, and that's what the average is in India, right? 5 to 8%. And you have a majority of your portfolio invested in traditional investments, like, for example, fixed deposits or insurance schemes, which typically, let's say, give you like a 5% sort of a return. At the end of the day, your overall portfolio is essentially going to give you a very low return. So, the point that I'm trying to make is that we are very worried about how equities perform on a day-to-day basis. But the point is that if you only have a very low exposure to risk in your portfolio, it's not really going to have a big impact both ways, right? Positively or negatively, right? But in the long term, not taking enough risk is actually eating into your returns in a very big way, because you're not beating inflation and you're not growing your wealth.
So, you've given us an example which we are also playing up on the screen right now, which talks about equity returns, which on a long term basis, I think it's safe to assume 12%. If anything, it's more than that if you invest it appropriately. And fixed deposits, as things stand right now, are still waiting. Mrin, incidentally, I was having a conversation with my dad this morning, and he's saying deposit rates haven't gone up yet, so we're all waiting for that to take place. Of course, it takes place with a lag, but it stands at 5.5% or thereabouts right now. So, could you explain the examples that you've given us?
Yeah, so if you have like a 5% exposure to equity and the balance in traditional investments, and assuming these returns of 12% per annum on equity and 5.5%, of course, on deposits, which is fully taxable, but let's just look at the pre tax returns. You're looking at 5.83% on an overall weighted average basis, versus looking at a portfolio which is slightly higher in equity. Let's look at 25% equity. You're looking at a weighted average return of about 7.15% in that case, which clearly is also going to help you beat inflation in any case and help you grow your money. So long term average inflation in India is about 5.5, 6%, right? So in that sense, you really need to ensure that your overall portfolio is beating inflation. And the only way that you can do that is if you're going to take enough amount of risk in the portfolio to do so.
Um, the second one that you've mentioned, and this clearly points out, right? Even in portfolio C, which you mentioned, is 50-50, and people who are younger would be advised to take a higher allocation to equity for their longer term goals, and therefore. To your point, where people sometimes don't take enough risk, this is very important, because I think people cut their teeth. Mrin, won't you agree, with fixed deposits or recurring deposits? They learn how to save that way, but they should evolve from that and look at instruments like equity. But the second point that you made is not investing in inflation beating investments. This is related to the previous point as well,
Yeah.
but how would you explain it?
So the first point, we talked about risk allocation in the overall portfolio. But even for specific goals, it's really important to look at what is the sort of inflation that's there for that goal. So, for example, on child higher education, the inflation is clearly 10% and above, is around 10%, right? So obviously you need to look at investing in an instrument that's going to give you a return higher than that 10%. So just to give you an example, let us say you need 20 lakh rupees 10-year down the line, and you're assuming a 10% inflation. It actually means that you're going to need something like 32, 33 lakhs 10 years down the line. And if you're only going to be investing this in traditional investments, which is what most people do, they go out and buy a child plan, and the child plans actually give them very low returns between 4 and 5%. But even if you assume like a 6% return, you're only going to end up having 25 lakhs. So there is going to be a shortfall in the overall amount that you actually need if you are not going to invest into something that's beating the inflation for that particular goal, right? So you look at having the right amount of risk on an overall basis, and also for that goal you need to figure out where to invest to beat inflation.
Now, in your example, if you're talking about the possibility of your child studying abroad as well, should you factor that into the picture? Because here you're not only going to have a higher cost, but you possibly also going to be facing rupee depreciation, which we've faced over the last several months. The rupee has in fact depreciated quite substantially. So if somebody is not planning for that, it could increase the cost by anywhere between 4 and 8 and 10%.
Absolutely. In fact, I think rupee depreciation is a bigger factor over there.
Yeah, okay, fair enough. All right, so let's talk about the third point, which is not investing based on goals. And I think, Mrin, the first thing that a lot of investment advisors, financial planner talk about is to set your goals and to have an investment strategy for each of those goals. What happens when you don't do that?
Despite all of us going on telling people to invest as per goals, it's really sad because most people actually invest in a very ad hoc manner based on what's doing well, or they chase market trends, and then they end up in a situation like today where they're not sure what to do with their equities, they're not sure what to do with cryptocurrencies, and so on and so forth. But I think, the biggest impact of not investing as per your goals is really you don't know what to do with your investment during volatile times, and you basically end up with returns with lower returns. The reason being, so for example, I found this study by Access Mutual Fund on investor returns versus fund returns, and you can see that there is a difference between the investor returns and the fund returns, only because investors tend to overreact to market sentiments. Again, they focus too much on short-term performance, and they invest in a very haphazard manner, right, instead of a very systematic manner. So these are the reasons why investor returns always turn out to be much lesser as compared to the fund returns. And I think all of this happens because you are not investing as per your goals, because you're investing in such an ad hoc manner and just chasing trends. So essentially what it means is that when you will need money for goals, you're really not going to have money for those particular goals.
Let's break this down further and let's talk about it in terms of how the equity markets have moved. All right, so let's assume that somebody started investing towards their retirement in March of 2020 when the equity markets fell the way that they did. So they had a great start to their investing journey. They have consistently invested over the period of since March to now, where you've seen that the Nifty 50 has gone from 7,000 odd levels to 18,000 plus. Now, in an ordinary situation, according to your example as well, you would have a mix of equity and debt, correct? So therefore, at some point, your allocation towards equity and debt would have shifted very sharply in favor of equity. Would that mean that you should have taken money off the table at that point in equity, and assuming that it has now shifted once again in favor of debt, with the kind of drop that you've seen from 18,000 levels for the Nifty 50 to about 15,400 now, And if you have a portfolio that is now lower on equity, is now the time to correct that difference?
Yeah, I mean, I think it's important to rebalance maybe on a yearly basis,
Yeah.
but I also believe that it's not, the rebalancing has to happen beyond a particular level. So, for example, if you're plus by about, gone off your allocation by about 15% or more, maybe then you look at reallocating. And, certainly I feel that right now, for example, if you do have a lower allocation to equity, you do need to add on that particular allocation. But again, keep in mind your goal, because for example, I just giving you a hypothetical example that had happened a couple of years back, because I met this person who had invested 5 lakhs for a 2-year period into an equity fund. Now unfortunately for that person, I met that person when the equity markets were down, and the person had actually lost 16% on the investment. So the 5 lakhs had become something like 4.5 lakhs. Okay. And this is clearly the wrong thing to do. So, while we're talking about having a higher amount of risk allocation in your portfolio and all of that, it has to somewhere tie in with your investment time frame as well. And, this is why it's really important that every investment that you make needs to tie in with your financial goals and the time to that particular goal.
Fantastic. I think we've made some important points here today, and I think today more than anything else is when people tend to not want to listen to advice, but hopefully we've made some sense, and it's certainly been something that I will take home with me. Thank you so much, Mrin, for taking the time.
Always a pleasure.